Morning. I love being together. You left me alone.
I know, I did. I could not do it last week. I woke up and was like, oh my gosh, I feel terrible.
Yes,
I feel terrible.
I know you did. And you're like, just do it. And I'm like, I can cancel it if you're not going to do it. So she left me alone last week. And if you joined us, you know that I talked about the market a little bit. And then I went rogue. She left me alone.
Did you take up the whole hour?
I took up, it ended up being 45 minutes because of questions.
Okay.
So it was good questions.
Good.
My presentation was 30 minutes.
Good.
Or plus or minus a few. But we talked about last week, in case you want to go back if you missed it, because Megan wasn't here and I get that. But we talked about how do you convert challenges to opportunities and overcome the reluctance to give up the low interest rate and move, waiting for rates to come down as a buyer, the hesitancy for buyers to pay over ask for some of those special homes, which we're still seeing, and clients' fear of losing money and having a housing bubble. So that's what we talked about while you weren't here.
All right.
That's good.
Good.
Yeah.
I caught part of it and then I went back to sleep. I legitimately slept all day on Thursday.
You did.
All day. I got out of bed at like 5:30 at night. I was like,
Yeah.
I apparently needed that.
You did.
We've been running hard and fast since about March when the market picked up again.
Well, and I think every single parent, right, is dealing with this right now.
Yes.
I mean, it's like that flood of, I don't even know what you call it, germs. We'll
Yes.
just call it that. I wanted to say viruses and then I wanted to say germs.
Somebody sent me an article that said that
Yeah.
August 24th is the most frequently requested day off due to sickness.
Is that
Because
right?
the kids
Right
go
after
back to
kids go back to
school
school.
and then they come home
Yes,
and they give the parents all the germs.
I get that.
So far, we've been okay without it. They might have struggled through a cold and I
Yeah.
didn't know about it.
Oh, so they didn't get sick, just you.
Just me.
Okay, good.
Just me.
Well, we talked a little bit. I'm going to make this quote a little bit quick, but I do want to start this because I don't know. And you've been having these conversations. It's a hard market. And some people are having these pops of business and you're seeing favor and then you're seeing bouts of quiet. I was talking to somebody yesterday and they're like, yeah, I'm kind of bored. And I'm like, bored is not in my vocabulary.
Yeah.
Right.
I'm not happy unless my hair is on fire.
I hate it.
I'm not okay if I'm not completely jam-packed.
Yes. And just fighting the thing. But there is a lot of stress right now, as you have said this several times, many times, in fact, that people today are selling if they have to. They're selling
to, and not because they want to.
Yes, the death, divorce,
birth, death, divorce,
yes,
loss or change of a job.
So when you bounce up against that, and the live this week, I didn't do it on the market. I did it on my, golly, everybody. It seems like a lot of people are going through divorce right now too.
Sure is.
You're feeling that too. So how do you start over, especially at an older age? So that's just where my quote is going to come from. And I want to double click on this as you listen to the market trends today, as you go into this weekend, as you serve your clients. I want to just share this quote, and you know that I'm spiritual. This could go with any faith, but empty your vessel every day. Turn it upside down, shake it out and smack it a few times to make sure your vessel is bone dry. That doesn't mean you're empty. It means you're ready to be refilled, renewed, refreshed by the Holy Spirit. Again, you can transfer that name with more than you can imagine. That's how you always end up with more, by giving away all you have. And I bounced into that and I saw that and I was like, oh my God, that just, all the hairs on the back of my neck stood up when I read it. Because as you deal with people in death and divorce and loss, and they're going through this, they have to sell, they have to buy, and you hold the keys to this financial stability and freedom. We have to take that to the next level. We have to get emotional with them and console them and have empathy with them, because that's what helps them break through the barriers.
Empathy is such a key indicator in this market.
Yes.
People are having tough transactions right now. And so empathy is so key in handling these kid glove transactions that are happening right now. Agreed.
Well, with that, I don't want to belabor on that, but I just want to, wow. I started that kind of heavy. I'm sorry. That's where my heart was, but I know we have so much to talk about. I know we have a ton to talk about. This was a big week for the economics. Tomorrow is a big day with the unemployment number. And so we're going to be definitely, if you haven't signed up for our Friday text, we're going to be talking about that. Where are we standing this week? Because we've been seeing a pop of business. Is the whole market seeing that?
So we ended up seeing, last week we saw a pop.
Okay.
Where units going under contract went up nearly 5% from the previous week.
Yes, I felt that.
This week they went back down again.
Okay.
And so it's interesting to see, because it's up, it's like 2 steps forward, 1 step back, 2 steps forward, 1 step back.
Okay.
And so overall, the market still remains tight. And so we're starting to see days on market start to creep up.
Yeah.
We're starting to see slowing in the luxury market. And so next week, we're taking off because of Labor Day weekend.
That's right.
And so I'll be at the Colorado Luxury Home Tour speaking at that at Infinity Park at 8:45 next Thursday.
And you'll have to give us the update on the shag carpet and the drapes that you see.
Yes. Yes. And so I'll be giving an update on that, but I've been pulling a ton of analyses from people that are interested. They're like, I have this Wash Park listing that's not selling. I have this Sloan Lake listing that's not selling. I've got Castle Rock at 1.5 million. That's not selling.
Okay.
And so I'm helping a lot of people out with that. And then also I'm getting a ton of questions right now on tax assessments came back, and if they were successful or not.
Okay. So they're starting to litter in, because I'd already been hearing about that. I heard Douglas County actually did not approve the majority of them.
You're kidding.
And I thought they were so ahead of the game.
Uh-huh.
Somebody had just told me that like 2 days ago.
Wow. I was successful in getting mine back.
You were?
I was.
Okay.
My assessment went up $600,000. They took $550,000 of that off.
Okay. That's substantial.
So good. But then my rental property in Thornton, they came back and said no. And so I'm going to take that to the next step and say, no, this is not. Yeah. This is not, you can't compare my house against the other sales that have been in the neighborhood.
Right. Well, I think that that's awesome that you're doing that. I did not fight that hard.
Yeah.
I got the no and I was like, okay. I got other things to do.
Nice.
Well, why don't we start the presentation? You want to kick us off?
Yeah, let's go ahead and hop into it. Okay. And so this week covers, let's see, let's get this up and running. Let's do this. Pop this up. We'll move this over here so that I can see it. Is it showing up on Facebook?
I am like heading there right now.
Should be this screen. Okay, great.
We'll see. Just it takes a second. It's on a lag. Okay, but go ahead and.
Okay, so this covers the week of August 23rd through the 29th. So we've now gone through 3 weeks of kids heading back to school in various school districts. And so that all kind of started in that second week of August, third week of August, fourth week of August. The last group of schools ended up going back to school. And so we've seen this kind of rolling power outage throughout the city as people head back to school, and it slows in certain parts of the city and then it picks up in other parts of the city. And so it's been interesting to sit back and watch and see kind of how that has been playing out. And so looking at what's been happening, keep in mind, I do put together the weekly highlight reel for you that gives you the quick dump of what's happening overall in Metro Denver. And what I've seen a lot of agents doing, which has been great, is if the slide's not moving. I don't think this.
No, it isn't.
Moving.
Yeah.
Okay.
Stop sharing.
Stop sharing.
Sorry about that, guys. Yep.
We'll restart. We'll do screen 2. There we go. Okay, so, but the weekly highlight reel is on page 2 of each report that I put out, and that gives you your talking points. And so I'm starting to see more and more agents that are putting together social media reels.
Yes.
And so take this information, copy it and paste it into ChatGPT. If you're not using ChatGPT yet, it is a life changer. It has streamlined a lot of my processes. It has been great to work with. But take that, copy and paste it into ChatGPT and say, create a 90-second social media reel for me to put onto social media.
Love that.
And then you can take that and you can paste it into an app called CapCut, which is I always screw up with what they're called, a teleprompter. It's a teleprompter app. So it scrolls along your phone. So you're looking at your phone as you're going through and reading it. So you're making eye contact with the camera.
So brilliant.
And you can go live on social media with all of this information. So I put all of that together for you guys so that you've got one social media post that you can go through and put out each week. So there's everything for you on one page. Looking at all prices, and again, our strategy sheet going into pre-COVID 2019. So I look at the data from 2013 through 2019 and excluded the pandemic years. But this is the time where we're talking to clients and we're talking about, do I want to list now or do I want to wait until next spring?
I'm hearing that a lot.
And so
Yep.
I am hard pressed to tell people that they won't get a better price for their home if they go through and they wait until next spring to list their properties. Because you can see here, your target listing month across the top in yellow are real hot months in Metro Denver are March, April, and May. And that really came about back starting in 2013 when our market became hyper competitive after we came out of the recession, where buyers got hip to the fact where if I want to be in a home by the time that the summertime rolls around, I have to start my hunt for a home earlier in the year rather than later in the year. There's so many agents that I talk to that think that the market is the hottest June, July, and the beginning of August, when in reality it's March, April, and May.
And we've even seen it, I mean, super hot in January, right? I mean, coming out of the gates is what we've been, it'll be interesting this year.
Definitely during the pandemic years, it was really hot starting in January. And really the kickoff to our season is now we've got Super Bowl and President's Day back to back.
Yep.
And so the weekend directly following that, so it's that last weekend in February is when the market really starts to pick back up again. And so I've had a lot of people that say, well, should I wait to list till October? Because you've been saying that September is one of the hardest months to sell in. They said, well, the odds of selling is lower, but if you look at all of the other metrics, waiting until October, November, and December, days on market goes up, price reductions go up, they get larger in size. Home prices tend to stabilize as we get into October, November, and December, but I would still encourage you to list as early in the year as possible. Now exclude this weekend. You don't want to list over Labor Day weekend.
Right.
And so showings end up going down by about 30 to 40%. And so people really take this weekend off. They go to the mountains, they're at the pool for the last weekend. They're not out looking for homes as we get into Labor Day weekend. I would also recommend that you do not make a price reduction going into Labor Day weekend, because you don't know if you're going to have enough foot traffic through that property in order to make that work. And so I would have suggested that you made that price reduction last week, or you wait until the weekend directly following Labor Day weekend to go through and make that price reduction.
Makes a lot of sense.
Yes. And so looking at where we are headed into September, you can see that the September sales start to turn blue and green. The odds of selling goes down, days on market goes up, the number of units going under contract in the first weekend goes down, and it really starts to cool off. October and November tend to be our coolest months of the year. December picks up just a little bit because inventory is down, and then there's that baseline level of demand that just lives out there, where it's the birth, the death, the divorce, the loss or change of a job, relocations happening in December, where the market tends to pick up just a little bit. But I would still recommend, because there are fewer transactions happening in December, that you list as early in the year as possible.
My second biggest month is always December. I cannot explain it.
That is interesting.
It is interesting. I think it's the consistency.
People trying to move around, like you, because you work with a lot of investors. Are they trying to move around stuff
before the year end? Yes. Probably that, or just the consistency. Like we don't slow down around the holidays. We keep moving. And Ashley, our marketing gal, said it's captions, not cap cut. Do you work with both captions and cap cut?
So the one that I use is, let's see. I use CapCut.
You use CapCut.
I use CapCut.
And it does the teleprompter too.
It does the teleprompter too. Yep. And so looking at where we are for our strategy sheets, I kept those in there for 2020, 2021, and 2022. And here looking at 2023, you can see that our hottest weeks, when I was tracking out the 26 metrics that I look at on a weekly basis, that we were hottest going from March through about the end of April. And then in May, it actually started to pull back and cool off just a little bit. It's continued to cool off as I add on each new row. The odds of selling is going down, price reductions are going up, they're getting larger. And so again, the sellers that are in the market this year are the sellers that have to move and not necessarily want to move. And so they're motivated. So we're seeing a lot of price reductions. And what I want to encourage you to do is not panic reduce your prices. We'll talk a little bit more about that when I get to the price reduction slides. But again, it's not a market where you're going to be under contract in 2 weeks. We're talking 3 to 4 weeks at this point. So I would encourage you to hold off on making those price reductions and not panic reducing your prices.
And we're actually seeing HPI, which we'll talk about in the second half, actually still going up. So the actual appreciation is still increasing.
Okay.
So it's, if sellers are still going out too high and they're having to come down to meet the market, then that's really on that, upfront conversation. But we're still seeing people are gaining value in their homes.
Interesting.
Yes.
Interesting. Okay. Average sales price has gone down though. And so it's interesting to look at the calculation between appreciation and average home sale price.
Agreed.
And so not quite the same thing. And so we use the average sales price or the median sold price.
So
as
much
kind of our
easier to get to.
benchmark
Yes.
rather than appreciation. And so here's our market dynamics chart where I go through and I track the inflow and outflow of business each week to see what's been happening. And our average daily active count continues to grow, and it went up by 1.7%. But it's not because there are a lot of new listings coming on board. We're actually down 7.6% week over week, with 993 new listings making their way to market. And that's down by about 10.5% from the same week 1 year ago. So it's not because new listings are coming to market. It's because our active inventory is just sitting longer. It's just sitting longer. Coming soons, we're down by about 8.5% headed into last week, with about 161 units in that coming soon status. Back on markets ended up going up by about 6.2%. And I had a really interesting conversation with my manager about 3 weeks ago, where I was looking at what was coming in for title orders, and I was okay with what was coming in for title orders. I knew it was going to be a down year, so I've been saving my money and not spending anything. But I was looking at what my final commissions were, and I was like, this isn't matching up. I was like, based on the orders that are coming in and what's actually closing, we're not seeing the same thing coming in. I'm not seeing what I would expect to be my income. And so had a conversation with her about cancellation rates for title orders that are coming in. And she said 25% are canceling.
Wow.
And then hitting the market again. Whereas where we were coming out of 2020, 2021, and 2022, our cancellation rate was like 9 to 10%. And so transactions are having a hard time sticking right now. And so I went through and I started pulling the closers and saying, why are your transactions falling apart right now? And they're like, it is everything across the board.
No one thing.
No one thing in particular. It's inspection, it's loan conditions, earnest money not showing up, but they couldn't pinpoint just one particular thing. And they said it's falling out at whatever the closest deadline is further out in the contract.
Got it. It's fear.
Yeah. There's a lot of fear in the marketplace right now. So it's important that we're bringing this information to our clients right now to properly arm them for this market so that they're not so fear-based, but we're making good decisions. My big concern is that if and when interest rates drop, if they even drop back down into the 5% range, 5.5% range, that we're going to see a run on the market again. And so this is such a great opportunity right now for your move up home buyers, where we're still under like 1.5 months worth of inventory for homes that are under $500,000. Where if you're under $500,000 and you want to jump up until the next bridge and use that equity to make that next purchase, you have an opportunity to move into that next market. And you have negotiating power in the over $500,000 market, where you can still sell for premium prices for under $500,000.
There's opportunity in there, depending on what price point you're at. Absolutely.
And especially if you want to move into the over $1 million market, you've definitely got negotiating power in that particular market. Closed transactions were down week over week by about 3.3% with 742 closings. Our month supply of inventory now sits at 1.6 months worth of inventory. So that means for every one buyer in the market, they have about 1.6 homes to choose from. Or at the current rate of sales, it would take about 1.6 months to go through and to sell all of the existing inventory right now. That's still considered to be an extreme seller's market because that number is below 2 months worth of inventory. So it's still a good seller's market, but it's not the same seller's market that we had back in 2020, 2021, or 2022. And so again, there's this really interesting paradigm shift that we're going through where sellers still think that it's 2022, buyers still think it's 2008, and we're actually right on track with where we should be from 2013 through 2019. It's just that adjustment of coming off of such a furious market for those 3 years that we now need to reset expectations. And so, for example, looking at the odds of selling, if we look back at 2021 and 2022, in 2022, we ended up peaking out in March, where we ended up getting up to like an 87.5% overall odds of selling. And then as we slid back down into the last half of 2023, when interest rates spiked up to 7%, by the time that we got to the end of 2023, our odds of selling over the holiday periods ended up dropping down to like a 35% overall odds of selling. And so a big shift there. Right now, we're sitting about a 51% 41% odds of selling. And historically, when I look back from 2013 through 2019, the odds of selling was 50%. So we're still right in line with where we had been from 2013 through 2019. That did fall week over week by about 1%, and it's down by about 2.4% from where we were 1 year ago. Still very far from a market imbalance. And so I've been seeing more classes coming out from just being on part of different email chains of people saying, get prepared for short sales, get prepared for foreclosures,
Yes,
get prepared for HUD transactions to come back up. And I don't foresee that in our market. Inventory is so tight right now because so many people refinanced into the 2s and 3s that now they don't want to move into a smaller house for more money. So they're simply staying put where they are. And so I don't expect inventory to get up to that 6-month mark of inventory for a long period of time. We're still not even able to build enough homes to offset demand.
and there was actually a report that came out this morning, and the delinquencies on mortgages, as well as the foreclosures and short sales, are still at record lows. So I know Bonnie had made mention on Facebook talking about these huge tax increases are going to cause a loss of some people of owning those homes. And it absolutely could cause somebody that mortgage payment might become unaffordable based on the increase in the increase in the insurance and taxes. Yet their low interest rates are maintaining a majority of that affordability. But when you're talking about this, it's interesting because we're so much equity and safety in the equity that people won't sell at a discount.
Right.
They'll just simply put it on the market. Where you're seeing delinquencies in the credit cards, you're not seeing the delinquencies in housing.
Interesting. And so based off of data from last week, in order to offset demand, we would need to be closer to about 23,000 available homes for sale. So that means that we're sitting at 27% of balance. So while we are trending closer towards balance, this is more of a seasonal cadence that we end up seeing where there are fewer people going under contract. As we get into the last part of the year, fall and winter, where fewer homes are going under contract. So we need fewer homes to offset demand. But again, we're still far from that switch where we would transition truly into a deeper buyer's market. Showings ended up going down this last week by about 3.4%. They're down from 1 year ago by 14.5%, where we said about 12,000 total showings last week. That means that you're getting about 1.9 shows per property per week. And so if you're not getting your 2 showings per property per week, this is your good indication that you may need to consider a price reduction at that point. Looking at shows to contract, we've been holding in pretty fast at about 14 showings to go under contract, with 889 units going under contract and 12,000 total showings. And so if you've had a total of 14 showings and no offers, it may be time to consider a price reduction at that point.
This is nerve-wracking compared to the last couple of years.
I know.
2 showings a week.
2 showings,
14 showings to get under contract.
Yeah, let's use a Nicole word. Let's double click on that for a second. And so if you look back at where we were in 2021 and 2022, you were averaging in 2022 about 25 showings per property per week. Now we're down to 2 showings per property per week.
It's the anxiety of being bored, right? That is. It's like, where are the people?
Yes.
Yeah.
Yes. And so shows per property per week tends to go down through the end of the year.
Right.
And so expect it to be slower, but it's really important that you're setting appropriate expectations for your clients going into that first weekend. And so the way that the showings are distributed, you get more showings in that first weekend than you do in subsequent weekends. And so you only have one chance to make a good first impression in the marketplace. And based off of closed data from last month, back in July, closed data still said that 45% of homes were under contract in the first 7 days. And of those units that were under contract in the first 7 days, they were still getting 102% of their original list price.
102.
102.
Which is really good if you're priced right.
First weekend. So it's so important that you are pricing homes appropriately.
Yeah.
That you are staging properties, that you are taking good pictures of these properties.
Yeah.
And it really deteriorates the longer that you spend on the market, the less percentage of your original list price you're ending up getting. In week number 2, it drops down to like 98% of what you were originally listed for.
Yeah.
And so if you're taking a client out and you're showing them a home and they say, well, it's been on the market for 3 weeks, your buyer's going, well, what's wrong with it? Why isn't it under contract yet? And so it's so important that you're getting it priced right the first time and you're pricing below. So if you've got comps that closed in July or if they closed in June, June, we're off by that by about 2 to 3 percentage points right now, where you've got to come down in your original listing price. Looking at median days on market, they jumped quite drastically this last week. So I was out last week. They dropped back down to 12 last week, but this last week they were up to about 17 median days on market right now. So that means that about 50% of the homes are under contract in 17 days or fewer, or 50% in 17 days or longer. So if you've been on the market 17 days or longer, it may be time to consider a price reduction at that point. Price decreases jumped pretty drastically this last week. They were down the week that I was out. They came back up again this last week, but we saw that of the units that went under contract, 40.8% of them reduced their price. And so we are starting to see more widespread price reductions and larger price reductions overall. Speaking of price reductions, the average price reduction for units that went under contract last week was about 5.5%, or about $40,000 off of that original price. And that's up 13.8% week over week. And so the moral of the story is that the longer that you wait to make a price reduction, the more likely it is that you'll have to make a price reduction. And if you wait longer, the size of the price reduction gets bigger.
So, which this all really lines up. I mean, if half of the homes are selling in the first weekend or the first 5 days, 7 days, I think you said. So if half of the homes are selling in the first 7 days and they're going for 102, it makes sense that you should start the price reductions right away, which goes in line with what the price, the close to list is, because it does go down dramatically that second weekend, right? Because people are taking action.
Yes.
Because this does not feel good.
Yeah. Well, and again, sellers are motivated this year because they have to move, not because they want to move. And so they're making those big price reductions
quickly
in order to get them under contract. When we look at up to $500,000, this represents about 27.1% of our overall inventory. You can see that you have a larger swath of available home or time to sell the property where the market is hot. January, February through the beginning of June, getting into late July, August, September, it tends to cool down. October really cools down, and November is really challenging as well. Here's our strategy sheet for 2023. And you can see that it really turned blue this last week as we were getting into kids heading back to school, where the market ended up calming down pretty drastically. For homes that are under $500,000, our average daily active count grew week over week by 7.1%, and our pending transaction count fell by 4.5%. So now our month supply of inventory is sitting at 1.1 months worth of inventory. And so I would circle back to those first-time home buyers that were looking in the springtime that couldn't be competitive in that market and bid over asking price. Circle back to them, bring them back out, and now they're going to have some negotiating power because we're over 1 month of inventory. Keep in mind that when we're below 1 month of inventory, that means that we have more buyers in the market than homes to sell those folks. And so that tends to draw out those multiple offers. Well, now we're over 1 month of inventory.
Right.
And so those homes are sitting a little bit longer and they'll have more negotiating power. New listings were down by 12.1%. We only had 328 new listings come back, enter the market. Back on markets in this segment were actually down by 6.7%. So they were a little bit stickier this last week, where we didn't see homes getting pulled from market. However, withdrawn transactions were up by about 50%. We saw 54 units withdraw. Pending transactions were down by about 4.5%, and closed transactions were down by about 10.5%. The odds of selling declined week over week by about 2.3%. We're sitting at about a 59.7% overall odds of selling. Again, we peaked out back here in spring of 2022, where we were at an 87% overall odds of selling when we were looking at homes that were under $500,000. In this market, we only have 17.9% of a balanced market. We would need to have about 8,300 available homes for sale in order to offset demand for that market. In this market, we're getting a little bit more showings per property. We're looking at about 2.8 shows per property per week, with about 4,200 total showings that were set. That was down 6.8% from where we were week over week for a number of showings that were set in the under $500,000 market. Shows to contract, they're looking at one fewer home overall in this market, where it's about 13 showings to go under contract. So if you've had a total of 13 showings and no offers, it may be time to go through and consider a price reduction at that point. Median days on market jumped this last week. It's been kind of up and down as we go through each week. And so we've been bouncing between about 8 median days on market. Now we're up to 12 median days on market. We had a couple of days we were sitting at about 11 median days on market. So there are people that are out there that are looking and they're picking up those properties that are coming to market that are perfect and ready to go, while others are sitting on the market and languishing. We ended up seeing that price decreases this week went up by 8.2% from last week to this week. And so it was 33.2% of homes in this market ended up reducing their price. So price reductions will continue to grow through the end of the year. As we got into looking at the average price reduction, it was actually a little bit smaller this last week at about a 5.9%. Oh, no, I'm sorry, it was larger this week, about a 5.9% price reduction, or about $23,500 off of that original price. 500 to $1 million is by far our largest price segment. And this is also our most interest rate sensitive category, where 90% of these folks require financing in order to get into a home. Target months to list in March, April, and May, getting into August and September really starts to cool down. September, October, here's listing in October as well. November and December cooling down. Here's our strategy sheet for 2023, cooling off, not quite as drastically as what we had seen earlier in the year, but it's definitely cooling off as we get further into August and kids head back to school. Overall daily active count, we saw about 3,500 total average daily active counts for this last week. Pending transactions ended up decreasing by about 3.4%, where we put about 489 units under contract. New listings coming to market were down by about 3.4%. So our month supply of inventory was sitting at 1.7 months worth of overall inventory. The odds of selling still remained flat, 51.5% overall odds of selling versus 1 year ago. We're actually up 1.3% from where we were 1 year ago. What's interesting to see is how high our active count ended up going last year as we got towards the end of the year into at the end of September and October, we were at over 4,200 available units for sale, whereas right now we're sitting at about 3,500 units available for sale. So our month supply of inventory hasn't changed that much or been driven up so much because supply has dropped and demand has dropped in respect to that, keeping our market tight. Looking at where we should be for balance, we should have about 13,000 available homes for sale in this market. So we're sitting at about 27.5% of balance. We're closer to balance in this market than we are in the lower priced markets. Still about 1.8 shows per property per week. Showings ended up remaining relatively flat. They were down by about 0.5%, with about 6,300 total showings that were set in the last week in this price range. In this market as well, we're looking at about 13 showings to go under contract. That is up from last week by about 3% overall. We saw median days on market take quite a big jump this last week. They were up by about 22.6% from the previous week. It was 19 median days on market. However, it is still faster than where we were 1 year ago. 1 year ago, we were sitting at about 13.6 median, or 13.6% higher median days on market. Price reductions took a jump again in this market as well. Motivated sellers are reducing their price. 45.4% of the homes that went under contract last week ended up making a price reduction. Price reductions also went up this last week. We saw about a $37,000 price reduction for homes between 500 to $1 million. Average price reduction was about 5% off of that original price. Once we get into this over $1 million segment, it has really cooled down this year. And so slowing in the luxury markets. Looking at our prime time to sell, March and April, beginning of May also look good for your target timeframes in which to sell in. Strategy sheets for the last couple of weeks, looking at where we are in 2023, you can see how blue these cells are starting to get, looking at the overall odds of selling going way down.
And you've been talking about this since the beginning of the year, that this higher price point, and yes, the interest rates have certainly slowed things down as well. but the luxury market is so much warmer in that March and April is what you've been talking about. So, and here we're seeing it multiplied, I guess, because of the interest rates too.
Yes, definitely. Average daily active count went up by about 3.5%. We were sitting at 621 units that were available for sale. Pending transactions actually went up this last week by about 10.9%. We put 61 units under contract. Month supply of inventory, we're seeing about 2.3 overall months worth of inventory right now. Back on markets, we saw 17 units return to market, so that increased by 70% week over week. New listing count is down by 19.6% week over week, with 74 new listings making their way to market in the $1 to $1.5 million segment. The overall odds of selling ended up dropping down to about 38.9%. And when we compare that back to where we were in 2022, we were up to about an 81% overall odds of selling. And now we're down to 38.9% overall odds of selling. And so the odds of selling has really slowed down in this over $1 million segment. In this market, we're still short of inventory, where we have about 26% of overall balance. In this market, we saw showings slow by 5.9%. We had 925 showings that were set between 1 to 1.5 million. We saw about 1.5 shows per property per week. On average, they're looking at about 15 showings to go under contract. So if you've had 15 showings and no offers, maybe time to consider a price reduction at that point. Median days on market took a huge jump this week. And so we saw 27 median days on market for those units that were on the market this last week. That was up from the previous week, where it actually went down to about 11 median days on market. So now it's up to 27 median days on market for what went under contract last week. Price reductions, we ended up seeing a 15% increase in units that made price decreases week over week. And so 45.8% of what went under contract this last week ended up making a price decrease. Price reductions are large. We're looking at about an 8.1% price reduction between 1 to 1.5 million. So it was about $111,000 off of that original price. Once you get into that over $1 million segment, in order to make a real difference, to get more people into your home, you do have to make price reductions that are around $100,000 in order to get it down an entire stretching tier.
That hurts.
That's a hard conversation to have. 1.5 to 2 million. This is the last price range that I can track on a weekly basis. We're looking at about a 2.8% of our overall market. Looking at our strategy sheets, February and March are really your best times to sell in for this particular price segment. Here's our strategy sheet for 1.5 to 2 million. And you can see our blue cells really starting to creep in as kids head back to school in this overall segment. Inventory is way up over where we were 1 year ago. It's up 52.8% from where we were last year. We had about 301 total units available for sale. Pending units, only 16 units went under contract between 1.5 to 2 million. Then that was down 38.5% from where we were 1 year ago. It's down 33% from where we were 1 year ago. 8 units came back on market, so we saw about 60% increase in that number. New listings were down by about 2.9%, but our month supply of inventory really shot up this last week, sitting at 4.3 months worth of overall inventory. So if you are moving into that over $1.5 million segment right now, 1.5 to 2 million, you will have some great negotiating power right now moving into that market. The odds of selling declined week over week by about 7.8%. It's now down to 29.4% overall odds of selling when we project that forward for the next 30-day period. Again, looking back to where we were back in 2022, we ended up getting up to about a 75% overall odds of selling versus where we were 1 year ago. We're down by 19.9% in the overall odds of selling. This market is closer to balance. We're sitting at about 36% of our overall balance. We should have 835 units available for sale, whereas we only have 301. So we're still short on supply, but we are closer to balance in this market than we are in some of the lower priced markets. Showings declined week over week by about 3.5%. We saw about 1.1 shows per property per week. So now we're averaging 1 showing one showing per
Mhm.
property per week versus where we were back in 2023, where we were looking at about 9 shows per property per week. So showings ended up going down pretty drastically. Shows to contract with people are getting picky in this market. It was 20 showings to go under contract last week.
I get it. You're spending that much money, especially if you're borrowing.
Mhm.
You need it to be perfect.
Yes.
Yep.
Yeah.
I get
And
it.
so people are getting really picky in this market. But however, those units that did go under contract last week were under contract in a median of 7 days. And so
Yeah.
numbers are kind of all over the board. Where we were last week, we ended up seeing that median days on market was up to like 50. So some of that aging inventory came off the books last week.
Yeah.
And the new listings that came to market last week are the ones that went under contract.
Yeah.
And so there is this interesting pool of potential buyers that are out there right now that are just waiting for that perfect home to come to sale. So again, it's so important that you are staging, that you're taking great photography, that you're decluttering these homes to get them ready for sale,
Yeah.
going through and making the necessary updates to the property so that you can get them under contract. Looking at price decreases were actually down this last week. Last week, they were really high, where we saw about 50% of the homes that went under contract last week reduce their price. Whereas this week it was only 23.1% of homes ended up reducing their price.
Right. Homes came on the market.
Yes, but the price reductions that we saw were very large. It was an 11.5% overall price reduction, or about $216,000 off of their original price in order to go under contract. Big price reductions in those markets. How are jumbo loan rates doing compared to conforming loan rates?
They're very similar.
They're very similar.
Yeah, they're very
Okay.
similar. Well, we're going to jump into the economics. I've been answering questions on Facebook. There is one question for you on Facebook. I'm
Oh,
gonna
then
leave
we've got
it.
about 6 questions that are over here. Whoa,
Yeah.
it's 10:41. What
I know.
happened? How did I go over 11 minutes?
You were on a roll. I loved it.
Holy cow, I thought I was going fast.
So good. So we're going to save the questions till the end. I apologize. We're just going to do this where we jump into the economics, because there's just some things that happened at Jackson Hole, and then we've got unemployment coming in front of us. So I want to touch on a couple of those things, but I'm going to speed up a little bit so that we can get to all of your questions within our time. But let's just jump in here really quickly, share my screen. There's a lot to talk about in this market, right?
There
And we
is.
talked for a lot in the beginning.
Yeah, we did.
We had a slow start.
We did.
And sometimes, you just have to have a lot of empathy.
A lot of empathy. A lot of empathy right now.
Guys, all right. So we started out with our quote this morning. I'm not going to repeat it, but let's just jump into what's going on. So we had the Jackson Hole Symposium this last week. If you were on our Friday market updates, we talked about it on the Friday text. We also did some quick reels on it. And I think I touched on the Saturday blog as well. But, ultimately, he didn't move the markets like he did last year. Last year, he talked about the fact that we needed to inflict pain on families and businesses. And this year, it was, we're going to stay higher for longer. We're going to continue to watch the data. And some of the things that he mentioned, though, is that although inflation has moved from its peak, that's great. We need to see more movement, and we need to see it more consistently, because we still need to see that he held true to the 2% target. He said a couple of other things. One of the things he said was, it's great that CPI and PCE came down, but 2 months isn't enough. And of course, if you paid attention this morning, PCE came out and it actually went up, and that's primarily due to the year-over-year comparisons. He also mentioned that housing is picking up. He's thinking housing's doing pretty good. I know. That's what I said. I said, huh? And so he's
the dog with the ears.
So, but to be fair, people are still buying.
Mm-hmm.
But that's the thing. There is the constant buyer that always has to buy because of death, birth, moving, because of job or loss. So you have that consistency, and the inventories come down so low that you are seeing, in fact, pending home sales nationally went up. Ours went down in July, but nationally it had gone up. So he's looking at national numbers. And then he said, okay, we want to see below trend growth for a period of time before we're willing to take our foot off the gas and start to drop the Fed rate. So we got to know that it could be well into next year before he drops the Fed rate. That doesn't mean that interest rates aren't going to come down because our interest rates are based, our long-term interest rates are based more on long-term inflation, but we are expecting it to take a while. And then he said, in conclusion, we are navigating by the stars under cloudy skies. And I say quippy stuff like that all the time, but I don't expect my Fed chair to do it. I don't know why. There's like a difference. We're navigating by the stars under cloud. That was pretty much my expression during most of the 18 minutes. So the Jackson Hole presentation or he doesn't take questions at Jackson Hole. So it was just him giving his speech at the Jackson Hole Symposium. It's like, okay, well, but ultimately what I care most about is the word choice he uses and the way the market moves. And the market didn't really move after he said what he said, because what he did is he just confirmed what he'd been saying and saying that we're going to stay higher for longer and be data dependent. So mortgage purchase applications actually went up 2%.
Okay.
Yes, that's after going down for 6 weeks. Despite rates hitting a 23-year high, because remember, this is last week. So this is the survey comes out every Thursday and it ends on Tuesday. So it's actually reporting last Thursday through Tuesday. It's kind of a weird. So it actually went up, but it's coming up off of all-time lows. You don't have to move up much to get a 2% up rating, but it's coming up. But since then, we've actually dropped significantly. So our interest rates dropped from 7.5%, which is where they were, 7.5 to 7.375, when that app was measured. So the fact that it had come down 2% during that period is phenomenal. But then it's dropped in the last couple of days. So why? Why? Because labor. We're starting to see some cracks. Now, I don't want to get too excited here because I don't actually think this is a trend. I don't think we're just going to go down. But if you look at this again, every time it spikes up, it comes down, and then it spikes up higher, and then it comes down, and then it spikes up higher, and then it comes down. The fact that it's coming down is not abnormal. So don't go, yay, rates are coming down permanently. And maybe they do, because there's actually a massive number of investors who have shorted long-term bonds. And that's kind of a weird, when you typically short stocks, you don't typically short bonds, but they were expecting rates to continue to go up. And if they go down and they go down significantly, they have to come back into the market and shore up their short positions. And that could actually lead to interest rates going down more. There's a lot going on behind this and too much to kind of really dive into during our time here together, but we could see a nice little pop down. I still don't think it's the bottom. I still think we're staying up here because we have not seen core inflation release from being sticky yet, right? But we're seeing some cracks. And if you get my Friday text, we had a joke about that on Friday. The root team likes to see cracks. We go looking for them. So, all right. So why? Labor came out. The JOLTS report came out. This is a big week for labor. JOLTS report came out and the open jobs actually came down significantly back to the number it was in March 2021. And if you actually think about the fact that a lot of the labor market, you might have people that put up multiple jobs across the country now that we can work from home, or they might post the same job with different keywords and different titles. So some of that might even still be inflated, but it came down significantly. We also saw quits, layoffs, and hires all trending back towards pre-pandemic levels. So that was good news and the markets liked it. ADP actually came out, although we question ADP because we're really going to be looking at the BLS jobs report tomorrow, but ADP came out with the fewest jobs hired in the month since last March. So, and we're really focusing around leisure and hospitality, education and health services, IT, manufacturing, financial activities. Of course, banking is still contracting. All of those were down significantly, but that did come down. And again, just showing a slight cracks in the job market. Initial jobless claims just came out this morning and it actually dropped, which you'd think it would go up. If I'm starting to see some cracks, I'm starting to see layoffs. But you got to remember, we're not seeing massive amount of layoffs. We're actually seeing quiet cutting. Quiet cutting tripled in the last year. I'm sorry, not quiet cutting. I typed the wrong word. Quiet quitting.
I was like, I haven't heard of this one.
No, I know. I'm sorry.
What's this one?
Quiet quitting. So quiet quitting and quiet cutting, I guess I typed the right word. So quiet cutting, that was right, is where companies aren't laying off because it's too expensive to lay somebody off.
Mhm.
They're actually saying that that job, that position has been removed. And so we're reassigning you to a new position, a lower position at a lower pay. Right? So it's
Oh,
quiet cutting. I did have the word right. So
okay.
when quiet cutting happens, and these are big jobs that are doing it, Adobe, IBM, Salesforce, Adidas, they're all saying that that position no longer exists, that we're restructuring the company and we're putting you into a different position. It's a lower title and a lower pay.
Oh, that stinks.
Right? But people, there's not an abundance of jobs right now. We just saw the JOLTS report. So if I move you into that position, it's on you to quit. And if you quit, you can't go on unemployment. Right?
Oh, that's stinky.
So that's why we're seeing that the initial jobless claims is coming down. So we're still seeing people leaving and moving, but it is going back, and we are starting to see some of these cracks. You guys are hearing it, you're feeling it. I know when I'm talking to people, especially in the bottom, probably 60% of Americans, they're feeling the pinch right now, and a little bit of a fear. GDP also came out, and it was revised from 2.4 to 2.1%, meaning the economy is not as bustling as the politics and the headlines would like us to think, right? We're starting to slow down a little bit. We're not there yet. We haven't dropped down significantly, but these slowdowns, along with the job numbers, if tomorrow we see that there's a significant drop in jobs, and or if unemployment goes up, we could see a nice run on rates going down positively. If the opposite happens, if we actually see that more people were hired and unemployment stays the same or goes down, we could see the opposite. We could see some of the gift that we've been receiving with lower interest rates retracts, and it starts to go back up again. But the GDP came out. Interestingly enough, this week was really good for a lot of investments. Gold liked it. That we're starting to see cracks in the job market. The stocks got a pop, of course, because it wasn't even a great month. So stocks got a nice little pop on that. And then the 10-year gave us that gift where it dropped down, and I just checked the 10-year and it's like at 4.07. So just even a little bit lower than this. And remember, with the 10-year, so goes our 30-year fixed mortgage rate. Those two are like that. They're sisters. Who didn't like it is the employees. They're not feeling confident right now. Glassdoor does an employee confidence index, and that's super low, specifically in IT and professional business. Construction is good, leisure and hospitality is good, but the employees aren't feeling it. And when you actually break down the numbers inside the GDP, there's a GDI, which has to do with the overall income that is gained over that period of time. So the gross domestic product is by those goods and services, and the gross domestic income is the income that we are making as a country, right? So the income has, if you can see this green line, it's dropped down below the GDP. They usually are neck and neck, and the income will be right above it typically. And now it's dropping down, which means people aren't making the same amount for the same amount of products produced, right? And that's what we're feeling. We're feeling that squeeze right now. That's starting to happen. So as we look ahead, the coming quarters, there are challenges. Student loans, as you know, are coming back, but consumer spending is set to slow down. Consumer spending is 70% of the GDP. We'll start to see this. Whether or not we go into an official recession or whether or not we just glide through this and have no landing is yet to be determined, but this is going to slide through the fourth quarter and into the first quarter of next year. And it's going to affect housing, right?
Yep.
PCE came out and they actually ticked up on both marks, on both headline and core. But if I look at the month over month, both of them were 0.2%. And remember, our target is 0.16. That gives us an overall 2% annual inflation, which is what we're headed towards. So to see 0.2, I'm actually okay with that. I'm happy about it. And so are the markets. That's why this just came out and the markets aren't reacting to it, because even though both the headline and the core went up a little bit, it's because last year the month over month was negative. So we replaced a negative number with a 0.2, and you're going to have it go up. So it's all relative. The shelter price is still not dropping to what it really is, right? So these two higher numbers at 7.8, that's the shelter cost, the owner's equivalent of rent that is inside the inflation numbers. So that's still holding it higher than it would be if they were the real numbers, which these are the Zillow apartment list and CoreLogic rents that are all showing much below 5%. In fact, apartment list is even slightly negative. So when you see that kind of real rent growth on new leases being signed, then you know that what's in the inflation numbers, it's just still lagging, which we're going to see that nice little drop when we have a nice year over year comparison again.
Mhm.
Consumer spending is up 0.8, which is down from what it was, but it's still strong. I don't think it's sustainable, right? I don't think it's sustainable, but we're continuing to spend. We're not saving as much. We're putting it on credit cards. We talked about this. About credit cards hit 1 trillion. People are spending out the excess savings that everybody talked about that we had from the pandemic, and all the federal stimulus packages has been spent. We're rolling into where that is going to be a zero very soon. It isn't yet. People are still spending it. So consumer spending, although not extremely strong, is still positive 0.8. Personal savings dropped again to 3.5%. Remember, the historical average is 8. We're at 3.5. I see it did a nice little tick down right there.
Wow.
So people aren't saving, which is a little scary.
It
right?
is. Yeah.
That's why we're seeing the delinquencies on the credit cards. That's why we're seeing some struggles. Why there was a mention on Facebook, and I don't have it open right now, so I apologize. I can't call out your name, but there's a mention on, what happens if you can't qualify? What if you want to save your home and the equity that you have in it? There are options. And that's one of the things that we've been talking a lot about, is the fact that, can we consolidate the debt? I don't love these interest rates any more than you do. And I don't love pulling somebody out of a 3%, but if they're burdened by higher property taxes, higher insurance rates, and higher interest rates on their HELOCs, if you got a HELOC 3 years ago, and that initial period, you know how you always get the sexy initial rate, like for a year or 2 years or 3 years, it's going to be this low rate. And now that's gone. And now primary is 8.5. And all of a sudden you have an 8.5, 9.5% HELOC. You've got 25% on your credit cards, and your tax bill just went up 44%, and your insurance bill just went up 34%. That all adds up really quickly. So consolidating that, putting that into the higher interest rate all together, and putting that into a 30-year fix is going to drop your monthly payment. If you take that extra money and you snowball it, that mortgage can be paid off, that 30-year mortgage can be paid off in 27, 25, 20 years, right? If you're diligent in taking what you were spending on credit cards, or maybe it just gives you breathing room. And then when the rates do come down, we're going to refinance you back into a lower interest rate, maybe not the 3%, but you'll be in a much better position. This is one of the options that I talked about on Facebook. Of course, there are others. Being strategic in this market is absolutely paramount. Case-Shiller Home Price Index, this is the numbers we were talking about, the appreciation just came out as well. So just a big week of news. I always wonder, am I going to have enough to talk about?
There's always enough to talk about. There's always enough to talk about.
Holy smack. All right. So the Case-Shiller also just came out. So it was that last one that we've been waiting on of the indices that show us what their interpretation of appreciation is. And it is just a hair under the all-time high. It came out at 308.25 versus the all-time high is 308.32. So we'll be there. We're just a whiff away. So then that means that all 5 will have hit all-time highs. So the actual home values continue to go up. Now, do certain neighborhoods are different than that? Certain metros are different from that. This is a national number. So I get that this isn't specific, but we've been regaining some of the loss that we'd had since February to now. And now we're going into our fall where the prices are starting to decline. And then we've got the higher interest rates. We just have to be able to communicate this story and get out of the fear about, I'm either going to wait for the bubble to burst. I'm afraid that I'm going to buy at the top. Being armed with this information and being able to communicate it in a way that helps them to move on with their life long-term, even if I lose a little, what I gain by not paying somebody else's mortgage, i.e. rent, and building my own and then refinancing and dropping the payment it's a win.
Mhm.
But it's not a win today. You got to keep talking about what does this look like for you if you bought today, a year from now, or 5 years from now, or 10 years from now. So we're about to hit that next month when Key Shelter puts it out, will probably be all across the board, red at all-time highs. Tomorrow, we will be putting out a text about the unemployment numbers and the job numbers that come out, because they will move the rates either in our favor or against us going into this weekend. I don't know if you need it, because I don't know how much you're shopping this weekend.
Mhm.
It's Labor Day.
Yeah.
So maybe it doesn't
Not a
matter,
lot.
but we are putting it out anyway. And then going back to that whole blended rate and the rate drop opportunities, we have the rate drop assurance that waives the lender fees. You guys have to be communicating that as well, just letting people know that they have the opportunity, they're not locked in, and this is where they gain the long-term value. Well, let's jump into some of those questions. We got
10.
Look
We
at
got
me.
10 and we got 1 minute to answer.
I sped up.
Uh-huh.
All right, here you go. You want to read those for us?
Yeah, if a seller is asking for possible percentage differences between selling now versus spring, do we have any solid percentage increases if they wait? So if they choose to wait between now and April of next year, average home prices tend to increase by approximately 5 to 7% higher by the time they wait until next April.
Right. A lot of that has to do with interest rates though right now. So just keep that in mind.
Yeah. What is the previous percentage of contracts falling out, title orders canceled versus the 25% happening now? So from 2020 through 2022, our cancellation rate was about 10% overall versus the 25% that we're seeing now. Are we not expecting a pop of activity now that kids are back to school and summer is over after this weekend? I had told some sellers we might see a list and might list in September, but should I be recommending next spring? I am hard pressed to tell them that they would be better off waiting until next spring.
They might get more, but then they're going to buy in that market.
They're going to buy in that market.
So are
too.
they
So
buying? Are they leaving the state?
Depends. Yeah, are they leaving the state? It depends on a lot of factors.
It does.
If they're also buying in this market, it might be worth it to take the hit on the price versus waiting until next spring when they're going to be in a competitive market again.
Yeah.
What was the percentage that did price reductions go under contract? It was up to, what was it, 40%? 40% made price reductions to go under contract last week. Are the price reductions based on list to close price or original to reduce price before going under contract, or both? It is the difference between the original list price and the last asking price prior to going under contract. For the odds of selling, what's the time frame? Is it the odds for the first week or the first month? So I take it based off of that week and I project it forward for a 30-day period of time.
Okay.
Average appreciation in Denver Metro this year, if any. And so since the beginning of the year, average home prices have come up about 8.5%. But when we look at it year over year, month to month, we're sitting at about flat. We're about 0.1% down for average sales price.
And these are average sales price. Okay.
Average sales price growth. What's the latest number for average appreciation in Metro Denver this year? Oh, we just did that one.
Oh, sorry.
Do you know a commercial lender that does weekly or monthly updates for commercial lending?
I do not.
No,
Nope.
This is unique to us.
Yes, it really is.
We'll get sent a copy and paste the market update section into Chat GPT. Yes, I will be sending that out between 11:30 and 2:30 today. And have you heard of the new 40-year FHA loan option? And what are your thoughts?
I have. So the 40-year FHA loan option is a modification loan. So typically you're not going to go into FHA getting a 40-year fixed, although there is conversation about getting 40 years, both FHA and conventional, on a purchase basis and being able to get it. Either way, I think what ends up happening is dang near interest only. You're not making any benefit in principal reduction. Now, if you were going to get that for a short period of time and then refinance it because you're going to refinance in 6 to 12 months, maybe it's a consideration, but that's like the 10-year car loan. Like, it feels very uncomfortable to me. In fact, we're the only country that has 30-year fix. Everybody else has like 2, 3, or 5 years.
Wow.
So to see a 30-year fix and now to extend it for 40 years, it's interesting. Of course, you just have to compare rates too and see how much of a difference does that really make to your payment.
Awesome. Well, that wraps us up.
Yes.
We are at 11:02, so we got to let you guys go so you can get on with your day. As always, thank you so much for tuning in. We'll be back not next week. We're taking next week off because of Labor Day weekend, but we'll be back at it. And we do have a live in-person Agent Ignite event in the 3rd week of September. So keep an eye out for your email for those registrations coming up. It will be here at Nicole's office. So space is limited to 75.
That's right.
So you want to RSVP soon. And if you RSVP, please show up.
That's right. That's right.
Please show up.
That's right.
We appreciate it.
Yes.
And so please keep us in mind for your future transactions. I'm Megan Aller with First American Title and Nicole Ruth with Movement Mortgage.
Yep.
And so we will see you at our closing tables, and we hope you guys have a great weekend. We'll see you later.
Bye.
Bye.